Good afternoon, everyone. Thank you for joining us and welcome to the first in a new series of financial wellbeing webinars that we are going to run in association with Evelyn Partners. This series marks the start of something new which we haven't offered to members before. It's a set of webinars aimed at helping members to boost both their advisory capabilities, but also to look after their own personal financial wellbeing. This first event in the series will focus on pensions with some top tips from the experts at Evelyn Partners. We'll have a technical overview and we will have a practical case study session, which will be delivered by Bertrand Pole, who is a pensions technical specialist, Alison Dean, a chartered financial planner, and the session will be hosted by Aaron Carey, who is an investment manager at Evelyn Partners. Before we get started, I'd just like to mention that the session will be recorded and the recording will be made available to everybody that has registered for the session. As a reminder as well, we have a great selection of recent webinars up on our website if you check that out at charteredaccountants.ie/Ulster. I would like to thank Evelyn Partners and welcome them on board. We are delighted to be working with you and look forward to rolling out the series to our members. The next webinar in the series is scheduled for Tuesday, the 6th of June, and will focus on professional wellbeing, you, your clients, your team. More details will be issued to members in due course. As we go through today's session, please feel free to put any questions you may have for the speakers into the Q&A box down at the bottom of your screen, and we will do the very best to address those before the end of the presentation. So we've a lot to get through and I would like to welcome Aaron, Alison and Bert. Over to you.
Thank you very much, Zara. Good afternoon and thanks for joining us. As Zara mentioned, I'm Aaron Carey, Investment Manager at Evelyn Partners, your host for this webinar, and I'll also speak a little bit later on about investments held in pensions. Today's session is all about pensions and the top tips for private client practitioners to be aware of for their clients' benefit, but also for their own. We'll aim to be informative, but also bring these tips to life using case studies from the field. As Zara said, we'll be led by Bertrand, Alison and myself. We expect the presentation to last about 45 to 50 minutes, leaving about 10 minutes at the end for questions. The sessions will be technical and full of value. Hopefully you find it worthwhile and you take something new away from it. So a brief word just in the format of the webinar. As is always the case, I'll caveat the presentation by saying that we are at the mercy of the technology. If chaos ensues and somebody speaking loses their internet connection, we will endeavour to continue, but please bear with us. If on your side you experience any issues, please just rejoin using the same link as before. During the webinar, we are inviting questions. If you'd like to ask these, please use the Zoom Q&A function at the bottom where questions are only visible to the panelists, and that's located at the bottom of your screen. In the event we run short of time, we'll follow up any unanswered questions directly. And lastly, we'll upload slides and the recording to the Chartered Accountants Ireland website, and a link to both of those will be sent to all registrants. Of course, no financial presentation would be complete without an important information slide. Tax rates and reliefs are dependent on individual circumstances and of course are subject to change, as we saw in the recent budget. This webinar is for professionals and is not a recommendation to invest or take any particular course of action. If anybody would like to speak with us with respect to an individual circumstances or in relation to a client, we'd be delighted to hear from you afterwards. And just to start a little bit about us, Evelyn Partners are a long-established UK-wide investment management and financial planning business. We've been entrusted with as much as 53 billion in assets under management by our clients across various offices, with the Belfast office currently managing 1.3 billion locally. In Belfast, we support clients at all stages of their life, and we also maintain a number of specialities, for example, advice to business owners, divorce, personal injury, and a dedicated charities investment management team. So without further ado, I'll hand over for the first half of the presentation to Alison Dean and Bertrand Pole, who will be speaking about making the most of allowances and reliefs, and of course, the recent budget.
Thank you, Aaron. Right, today what we're going to do, we're going to talk about various things. Now, there were a few other things that we were going to talk about, but we've had to take them out because obviously the budget has changed all that. So we're going to talk about the budget, changes to pension allowances, and what this means for pension savers. We're then going to look at pension contributions and tax relief and how relief works for personal contributions. We'll look at regaining the personal allowance, and then we'll look at salary sacrifice or salary exchange. Now, tapered annual allowance is still with us, so it hasn't gone, so we'll be talking about that. And the lifetime allowance test on death. Now, I know what you're thinking. Hasn't the lifetime allowance gone? Well, it has and it hasn't. There are certain circumstances where there'll still be a tax charge. Next slide, please. Right, the spring budget. What's changed? Well, the lifetime allowance charge has been abolished on any excess from the 6th of April, 2023. A lifetime allowance will be fully abolished in a future finance bill. Now, we don't quite know what this will be because there are quite a few nuances that need to be ironed out, but obviously, it will be completely done away with. Members without lifetime allowance protection will be limited to a maximum tax-free cash of 25% of the current lifetime allowance, which is 1,073,100. So that's a tax-free cash of 268,275. Now, if you have fixed protection, say, for example, 2012, you will be able to have a higher amount of tax-free cash of about 450,000. Now, if you have used up your lifetime allowance, you may not be able to take any further tax-free cash. Lump sum benefits in excess of the lifetime allowance, which would normally be charged at 55%, will now be charged at the recipient's highest marginal rate. So this is what I mentioned, it hasn't completely gone. So this includes lifetime allowance excess lump sums, serious ill health lump sums, defined benefit lump sums, and uncrystallised fund lump sum death benefits. Now, the good news is the standard lifetime allowance has increased from £40,000 to £60,000. The minimum tapered annual allowance, this is for high income earners, it's increased from £4,000 to £10,000, and the threshold from which the annual allowance will be tapered down has increased from £240,000 up to it's increased, sorry, to £260,000. And the money purchase annual allowance, this is if you have accessed your pensions flexibly, has increased from £4,000 to £10,000, giving scope for people who have access to pensions to still save. Next slide, please. So what does this mean for pension savers? Well, basically, members who have opted out will stop contributing because they were close or over the lifetime allowance or had some sort of protection which prevented them from accruing benefits or contributing to a pension can now opt back in because they'll no longer have to worry about that. Those who are close to retirement will have more opportunity to catch up on savings because the annual allowance has increased to 60,000. Not only that, carry forward is still with us. So if you've got somebody who's not saved into a pension for the last 4 years just before they retire, they'll actually be able to put 240,000 into a pension. So this is a really good way of getting, wealth extraction from a business, profit extraction, etc. Certain pension benefits are still caught by the lifetime allowance, as I mentioned. So certain things like death benefits, so death in service will still be caught. So if you have somebody with, say, 8 times death in service and they've got a high salary, they might want to consider an accepted life policy. Now, those who previously lost protection or approaching age 75 and are well over the lifetime allowance will have a reprieve from the lifetime allowance charge. And those who previously stopped contributing because they triggered the money purchase annual allowance, which was quite common during lockdown or during the pandemic, can now save up to 10,000. Now, it's not 60,000, but it is something, and it still gives them scope to save for a pension. Next slide, please. Right, now we'll look at contributions and how tax relief works. So with personal contributions, there are 2 ways in which you can save into a pension. There's the net pay arrangement. Now, this is really straightforward. It's normally done through an employer scheme where they deduct your gross salary before tax is calculated under PAYE. You receive tax relief immediately at your highest marginal rate. Now, it's not suitable for anyone earning below the minimum or personal allowance, which is $12,570, because they won't get the uplift that they would do if they used relief at source of 20%. So relief at source this is where you make an individual contribution into a pension. You make it net of basic rate tax. The provider will claim 20% from HMRC and apply it to the pension fund. So any higher rate or additional rate can be reclaimed. Now, you can either phone up HMRC or do it through tax returns, and you have up to 4 years to reclaim this. Now, I did this myself. I've got a personal pension, and I completely forgot to claim my high rate tax for about 3 years. I phoned up HMRC, and they just sent me a big check for it. Now, sadly, 80% of high rate taxpayers and 50% of additional rate taxpayers never claimed this tax back. And that amounts to about £1 billion of unclaimed tax relief, which is research done by a company called Pension B. So if you have anybody in this situation, you really need to get them to check. And it's really straightforward. You just phone up HMRC, tell them how much you've been putting into a personal pension, and they'll just send you a refund for the higher or additional rate tax. Next slide, please. Now, this is another thing you can do with pension contributions. is to reclaim your personal allowance. So if you earn over £100,000 a year, between 100,000 to 125,140, for every £2 over, you'll lose £1 of your personal allowance. So effectively, it extends your high rate tax band. So what this means is that between those two levels of income, you're paying 60% tax. So what you can do, if you make a pension contribution, you bring your net relevant earnings down. And if you bring it down to 100,000, you'll actually get your personal allowance back. So effectively getting 60% tax relief. All right. Next slide, please. So here we have an example of the amount of tax relief that you would actually get. So on the left-hand column, we've got somebody who's decided to opt out. They're not making any pension contributions. They're earning 125,140. If you take away tax and national insurance, this gives them a net income of £76,602.60. If you look on the right-hand columns, they make a net contribution, net of basic rate tax of £20,112. This is grossed up by the provider getting 20% tax back. Take away tax and national insurance, your net income, obviously you'd have to claim your high rate tax back, would be 66,546.60. Now, if you compare this to the left-hand column, that is a £10,000 net pension contribution. But look how much goes into your pension. You've got 25,140 going into your pension. So you're getting £15,000 back just to make a £10,000 contribution. So it is definitely worth doing. Now, the good news here, because the annual allowance has now gone up to 60,000, if you've got somebody earning 160,000 and they really don't need that money, they could actually make a contribution of £60,000 a year and bring their net relevant earnings down to 100,000. So they're not only getting 45% tax relief on a large proportion of it, over 125,140, but then between 125 or 100 and 125, 140, they're getting 60% as well. Next slide, please. Right, salary sacrifice, or salary exchange as it's properly known. This is one of the most underused tax-efficient ways in which to contribute into a pension. So salary exchange is effectively where you have an agreement with your employer to exchange part of your salary, and in exchange, the employer will make an employer contribution into your pension. Now, not all employers offer this, but more and more of them are doing it. Now, what are the main benefits? Well, both the employee and the employer save on national insurance, which you don't save if you make a personal pension contribution. Now, a generous employer will decide to add their national insurance savings to the pension. So effectively, they're increasing benefits to their employees without it costing them anything. Now, anyone earning up to 50,000 to 70, they actually will save 12% national insurance on their personal contributions. Now, the disadvantage of it, it could impact on certain state-related benefits, such as maternity or paternity pay, and you may not be able to borrow as much from a mortgage lender. However, saying that, most mortgage lenders tend to look at your pre-salary exchange salary. Next slide, please. Right, let's look at an example and the effect this has if you make a personal contribution compared to making a salary exchange contribution. So we got John, who currently earns £80,000 per annum, and he pays £10,000 into his employer's pension via the net pay arrangement. His employer pays 3%, which amounts to £2,400. John's employer have offered salary exchange and agreed to add employer national insurance of 13.8% to his pension. So they're very generous in that sense. So if we look on the left-hand column, his gross earnings is £80,000, less the pension contribution, less tax and national insurance, gives him net income of £49,449.40. Now, if we look at after he's exchanged £10,000, his salary is £70,000. Take away tax and national insurance, his net income is £49,649.40. So he's already £200 better off. So his net income is better off. However, if you look at the line below, because his employer is quite generous here and they're going to give him the 13.8% employer national insurance, he's now got £1,380 more going into his pension compared to if he was just making a personal contribution. So this is a way an employer can increase benefits to their employees without it costing them anything. And more employers are beginning to do this. For example, where we work, or where I work, if I went to payroll and said, right, I want to put £10,000 more into my pension, they would do it via salary exchange by default. I would actually have to opt out if I didn't want to do that. So next slide, please. Right, tapered annual allowance. Now, unfortunately, this didn't go in the budget, which I could understand why, but it's basically where the annual allowance is tapered down for high income earners. So the current annual allowance at the moment will be, from the 6th of April, is £60,000 per annum, unless it's tapered down or the money purchase annual allowance has been triggered. Now, all contributions, including employer, employee, and defined benefit accruals, count towards the annual allowance. Now, any unused annual allowance from the previous 3 years can be carried forward. Next slide. Right, so what is the tapered annual allowance? Well, it came into force on the 6th of April 2016. The rates were increased in April 2020. This was due to the pandemic because a lot of health workers who were doing overtime were being caught by it, and it was discouraging them from doing it. So it had to be all hands on deck because of the the serious situation that we found ourselves in. Now, the rates have increased again, or will increase again from the 6th of April 2023. For the same reason, they've given, it's actually catching out a lot of high income earners in the health service. The threshold income is 200,000. Adjusted income limit is 260,000. So the annual allowance reduces by £1 for every £2 over the adjusted income. And it reduces, well, this is from the 6th of April. It's not now, because at the moment it can actually taper down to 4,000. But it goes from 60,000 all the way down to £10,000. Next slide, please. So the way in which it's calculated is quite straightforward. You first do a calculation known as the threshold income. So threshold income is total taxable income. Now, this is all taxable income. This is not just what you earn. This is rental income. This could be bank interest earnings, patent income, and dividend income. You deduct gross personal pension contributions off this. Now, this is quite important because this is where you can manipulate your threshold income amount. You add any salary exchange, which was set up on or after the 8th of July 2015. So this is to prevent people manipulating their threshold income by using salary exchange. And you deduct any tax lump sum death benefits you receive. So this would be a pension from somebody over the age of 75 who's died and you've received it and you pay tax on it. So even though it's taxable income, it's not included. Now, if this is over 200,000, you then move on to the next calculation, which is adjusted income. Now, adjusted income is the same, taxable income, from all sources. You add back in any personal contributions if it was done via the net pay arrangement, because this reduces your taxable income. You add any employer pension contributions. Now, this is what makes it different to threshold income. And for defined benefit scheme, this will be the input less any employee contributions. And then again, you deduct any lump sum death benefits, tax lump sum death benefits. Now, if this is over 260,000, for every £2 over, it will reduce your annual allowance by £1. And it will keep doing this all the way until the minimum of £10,000, where your adjusted income would have to be over £360,000. So 360,000. So this is effectively catching a lot less people than it did before. Next slide, please. So here is a way in which you can obviously mitigate the annual allowance by making a personal pension contribution. So let's say your annual your income is 270,000. If you had enough carry forward, you could make a contribution of £70,000 to bring your threshold income below 200,000. You would need carry forward to do this, but as the annual allowance has gone up to 60,000, it would be a lot less. Now, Alison, I understand you have quite a few clients who have been caught out by this, and you've been able to help them on that.
Yeah, definitely, Bertrand. I mean, the increase to the tapered annual allowance up to £10,000, it's definitely a welcome relief. I've been able to advise quite a lot of clients over the last 2 years to contribute amounts to their personal pension to bring them back under the threshold income so that they're not subject to the adjusted income calculation. And you slide the example of the 70,000 contribution, that really brings it to life, as you say. As long as they've got the carry forward to support it, it's a great result for them. Another thing to be mindful of around the tapered annual allowance is anyone that has used their carry forward and is subject to a reduced annual allowance, it's beneficial to check what the employer is actually paying in for them. I have a client at the moment, her allowance has been reduced fully down to 4,000 and a company paying in a lot more than that. So it's making clients aware to check that, and they're not being subject to the tax charge as well. So that's another point on it. Thanks, Bertrand.
No, it's okay. I mean, my understanding this also happens when people get a big bonus or they're made redundant and they want to make a pension. Is that right? So,
yeah, absolutely. It's another thing to be mindful of. Absolutely.
Great. Okay. Next slide, please. Right. I was going to take this out, but I decided to leave it in because this is the lifetime allowance test on death. Now, this is quite important because there is still a tax charge. Now, we don't know what will happen after 2024, whether they'll do away with that. But at the moment, the lifetime allowance is still with us. However, some of the charges have gone, but some of them, it's still there for lump sums. So if you die below the age of 75 and the funds are distributed within the relevant 2-year window, so the relevant 2-year window is 2 years from death or 2 years when the provider could have reasonably known about death. You have 3 tests. Now, BC 5C and 5D, this is where it goes into a beneficiary drawdown or you purchase an annuity. These will no longer be charged on any excess over the lifetime allowance. However, BC 7, this is a relevant lump sum death benefit, will be caught out by this. So this is uncrystallized pension lump sum paid out, well, uncrystallized pension funds paid out as lump sum. Group death and service. Now, as I mentioned earlier, you might want to consider an accepted life policy. So if you have a very high income owner and they have a large pension pot, this will still be caught out and they'll have to, the recipients will end up paying tax at their highest marginal rate. And obviously defined benefit lump sums and pension term assurance, which still exists. So the main thing to be aware of is the uncrystallized pension fund lump sum. This can actually go into a drawdown pot, and a drawdown pot can be paid out in its entirety the very next day tax-free. So it would almost be negligent to allow that to be paid out as a lump sum if there was not sufficient lifetime allowance left. I understand, Alison, you come across this quite a lot as well, because providers don't actually help them with this. They don't have to do the calculations. Is that right?
That's exactly it. And a lot of people do come unstuck here, Bertrand, because they think that the provider will do the calculation, but they don't. It's really down to the executors. And that's where we've seen cases with too little tax paid or too much tax paid. So it's really mindful to get this checked as well, to do the due diligence on it. You mentioned the 2-year window there. That's really important. I have recently been approached by a lady that was not aware of the 2-year window. It was in a vulnerable situation. Husband had passed away and nothing was done. Past the 2-year window, it's now become taxable. And there is nothing that can be done at this stage. So it's such a shame. So that's another point. And the other point that we come across as well a lot, I think, is being very mindful to get the expression of wish on file as well. Because when the expression of wish is there, it's in trust, then you don't have to wait for probate. Again, clients, husbands, wives have passed away, and that money can be transferred to them, well, very, very quickly, and they're not waiting for probate. So they've got money when they need it, whereas the probate at the moment, because of COVID and things like that, it is actually being delayed. So that's another useful thing to have, that expression on wish. Such an easy thing, but it is missed. And the 2-year window, yeah.
No, thank you, Alison. Right. Well, that's my section done. So over to you, Aaron.
Hello again. So that's back to me. During this second half, I'll touch on what's inside your pension and how that impacts you or your clients. So firstly, maybe a bit of context. Why does this matter to me? To the silent majority, I'd say your pension is probably an amorphous blob of investments that you expect to grow and somebody in the background is sorting it out. Well, that's probably fine for the silent majority, but to us as advisors, and that I suppose includes accountants in particular being the go-to person for all things numbers for many clients, a massive portion of your client's wealth may be in their pension, and having an awareness of what drives the value of that can only benefit conversations with our clients, add to the credibility in conversations around clients' wealth, and of course, benefit our own understanding of our own pensions. So I thought I'd break it down initially by a person's time horizon. So starting there with the late career client, this is somebody who might have a material pension pot of about 1 million. Well, could be more now in future after the budget. Depending on how that's invested, markets can fluctuate up to 25-30% in a reasonably short period. and that amounts to hundreds of thousands of pounds in some cases. These clients are probably going to be more focused on the actual volatility or risk of the portfolio itself. At the other end of the spectrum, early career people will have a long runway of 20, 30, 40 years, during which time money invested early does much of the heavy lifting in terms of returns. These early stage investors have the right to ask themselves, am I taking enough risk, with a view to aim for a commensurately higher return over the longer term time horizon? And then clearly, mid-career people have a balance to strike between these two. So continuing to consider context, most modern pensions are literally just pots of investments, i.e. portfolios, and you might hear me sort of interchanging between portfolios and pensions. And investments held in pensions can be grouped into three broad asset classes: equities or stocks and shares, bonds, which are debt, and alternatives, which is a bit of a catch-all for everything else, really. Without teaching people to suck eggs, stocks and shares tend to provide higher returns over the long term, but exhibit, I suppose, greater fluctuations in their value or volatility, whereas bonds tend to be lower return, but with lower volatility, and alternatives do their own thing slightly. I'll make use of history to give you a flavour of these asset classes and why we use them together. So looking firstly at equities and bonds, the graph you see here represents returns since 1989 for the 10-year US Treasury, which is a good measure of returns for bonds in the US, and the S&P 500 index, which is a good measure of returns for equities in the US. So bond returns on the y-axis and equity returns on the x-axis. So without going into the detail of it too much, in the top right-hand quadrant, you'll see that actually most of the time, bonds and equities move positively together. But in the top left-hand quadrant and bottom right-hand quadrant, you'll see quite usefully when one of the two moves negatively or has a negative return in a particular month or year, the other will have a positive return to offset that, and so kind of balances off those positive and negative returns, smoothing off the returns of the pension or portfolio. In fact, there are a select few dots in the bottom left-hand quadrant where both bonds and equities delivered negative returns. And for those who follow the market, you'll know that the bottom left-hand quadrant was largely returns we saw last year. So two things to take away from this then. First of all, bonds and equities generally work together to either deliver positive returns or offset one another to balance out the returns of your pension or portfolio. And the second thing then is last year was a bit of an anomaly where both delivered negative returns, and we consider last year to be just that, an anomaly. This is an interesting graph. I wonder if I asked the audience which performed better over the past 5 years to the 1st of February. World equities, emerging market equities, 10-year gilts, or gold. Kudos to anybody that would have said gold. You'll see just that from this graph, showing gold moving, first of all, very differently to other asset classes, so gold being the gold line handily, but also performing very well. Admittedly, some of that was due to strength of the US dollar, but gold also benefits as an inflation hedge, and it does well then in periods of inflation fear. So gold forms part of that third alternatives bucket I mentioned, and is a good diversifier for client portfolios or pensions, often performing well when other asset classes don't. Again, I'm just highlighting that there is an importance to understand what you own and how this plays into the way our pension values are protected. So this graph is simply to show that what we will experience in the next 10 years in our pensions may not match what we saw in the previous 10 years. As we all know, interest rates are rising, shown clearly here for the US, UK, and Europe, which is a massive factor in asset class performances. So I'll touch on how interest rates impact asset classes inside pensions in the coming slides. So finally, just on context, how do the asset classes, those three asset classes, fit together in actual pension pots? You'll see here three examples of hypothetical pension pots, ranging from defensive, which is typically more for that late career stage client that I described, to, on the very right-hand side, growth or rock and roll, typically more used for those early career clients. Clearly, as we move left to right from the purple tables below, as you would expect, by increasing the equity exposure, you do see an increase in both return but also volatility. Comparing the asset classes at the extremes, the defensive pension pot has 40% in bonds, 30% in alternatives, and only a 20% allocation to equity or stocks and shares. That's compared to the growth portfolio on the very right-hand side. That's almost all equity. So there's a big divergence there in those two. I want to initially focus on a later career defensive pension first. Clearly, this pension relies less on the performance of equity and more on the performance of bonds and alternatives. So that is so important to know for advisors, because these are the clients with up to £1 million, and in fact now more in their pension pots, who may be focused on fluctuations far more than return. So at this stage, you might be asking, Aaron, where are the top tips? Well, here's the first one. Understand duration of the bonds in your pension. So as I said, we'll focus first of all on that late career focus. In a hypothetical defensive pension pot, as I said, we have a 40% allocation to bonds, which might amount to £400,000 for a £1 million pension. So what determines the risks in bonds? Duration of a bond is a measure of how long a bond is outstanding for. I will explain that in the next couple of slides, but first I want to show you the impact of duration on bonds using an extreme example, albeit it is an extreme example. Index-linked government bonds are known to be some of the lowest risk assets available anywhere. These are debt backed by the government and linked to inflation. This graph shows the returns of a host of asset classes during 2022. Something utterly baffling, frankly, that happened last year was that the worst performing asset class in GBP terms was the super low risk UK government index linked bond. Comparing that with the US equivalent, which performed less bad, we should be asking ourselves, how could this happen to such a low risk asset? Currency fluctuations played their part, but the answer lies actually more so in duration. UK government bonds, on average, are outstanding much longer, 30 plus years on average, in fact, than their US counterparts, which are outstanding for about 8 years on average. This massive difference in duration led to the UK bonds being impacted much more severely by interest rate changes. So duration can have a massive impact on your hypothetical 40% bond allocation. For compliance reasons, I had to include this slide, which effectively shows that last year was an anomaly. But I was just using last year's data as a tool, effectively, to highlight the importance of understanding duration. So we can effectively skip this slide. So how does duration work? It's probably best explained using an example. A bond is an instrument that you can invest in. And by buying a bond, you effectively loan money to a company or else a government. It's a loan. In this example, you loan BT £100 and you're paid an interest rate, as with any loan. Here, the interest rate is 3% for 10 years, after which you're returned your £100. If instead the loan was for 40 years, clearly that represents higher risk to you as the lender. Will BT exist in 40 years? What will the economy be doing? What will interest rates be doing? This increased risk means that the value of this particular bond will fluctuate more readily than that shorter duration bond. The critical thing here is the link between bond values and interest rates. Earlier, I mentioned to make this connection between asset values and interest rates. Interest rates rising impacts negatively the value of a bond. And a longer duration bond is worse, more so impacted. So this link to interest rates is so important to this presentation. In our hypothetical defensive pension with 40% allocation to bonds, a long duration bond exposure could be quite volatile in changing interest rate environments. And that's what we saw last year. So the duration of a bond, fund rather, in your pension is usually available to you from the fund fact sheet. So I would estimate about 1 to 5 years would be considered low duration, 5 to 10 medium, and 10 plus years long duration, or kind of in that higher risk bracket. So that's the first top tip. Understand duration, particularly for older, more defensive, and then possibly higher value pension clients. So now on to that third bucket, that alternatives bucket. Remember that for a defensive later career client with the hypothetical 30% allocation to alternatives, they might have a pension of £1 million and therefore about £300,000 in their alternatives bucket. As I mentioned, it's a bit of a catch-all for everything outside of equities and bonds. So, running through this slide, for example, you've got gold there in the top left-hand corner. We touched on gold briefly, and we will actually again later in the presentation. In the bottom left, we have property. So you can have property funds. In the center, private equity, which would be a kind of a higher risk aspect to that alternatives bucket. The bottom right there, infrastructure funds. So that might be renewables infrastructure, or investing in a bridge effectively. In the top right-hand corner, anybody that's seen The Big Short, that's Michael Burry there running his very successful hedge fund, and hedge funds form part of that asset class as well. So there's different types of hedge funds, not just the successful one that Michael Burry ran. I want to focus on infrastructure and property. These two assets have been growing in importance in recent years and have been forming larger parts of pension pots within that alternative bucket due to their seemingly low risk, high income, inflation-linked nature. This nature has led to them being referred to as bond proxies, i.e. property and infrastructure share similar characteristics to bonds. So this is a share price graph of International Public Partnerships Limited. I selected this as an example of a stereotypical infrastructure fund. It's not a recommendation. So now enters top tip number 2. Bond proxies are sensitive to interest rates as well. Cast your minds back to the ill-fated mini budget of 2022. Without going into the detail of it, we all know that the budget caused a ruckus in financial markets and interest rates spiked. Interest rates going up, as mentioned, negatively impacts the value of bonds, and indeed the same can be said for bond proxies. Here we see a sharp hit to the value of this infrastructure fund at that time. In fact, this was the same right across infrastructure funds. The same can be said for property. This graph of Warehouse REIT, again, not a recommendation, but just a representation of property generally, was hit hard by the interest rate spikes during that mini budget period. Infrastructure and property may form a decent proportion of a pension portfolio. For that defensive pension holder, together, property and infrastructure might make up 5 to 15% of the pension. This, together with the 40% bond allocation, might make up over half of your client's pension, or indeed your own. So we need to be alert to the impact of interest rates on our clients' money through bonds, infrastructure, property, all that good stuff. So that's quite a bit on bonds, bond proxies, and interest rates. Really high octane stuff. I thought I'd also give an honourable mention to our old friend gold. Gold forms part of that alternatives bucket. It might be around 5% of that defensive later career pension pot. Gold is a useful diversifier in portfolios. It's an inflation hedge and a safe haven asset. When inflation is on the rise or when chaos is broken out, people run to gold, which makes it a useful ballast, performing well when other assets are in trouble. One excellent example of this was during the COVID pandemic. As shown by the graph, when gold pushed on, when world equity struggled, and the aftermath of worldwide lockdowns. Separately, and as a matter of interest for those who follow markets, an interesting dynamic is appearing in gold at the moment. When Russia invaded Ukraine and the developed economies struck back by sanctioning Russian reserves, i.e. Russian government cash held outside Russia, held in the Western economies. So this represented a massive threat to onlookers, for example, China. If the West could sanction Russian reserves held outside Russia, they could do the same to China. So an alternative strategy for China and other similar states was to buy up gold and hold that instead. So this has led to a spike in demand for gold, as you can see from the graph on the right-hand side from the World Gold Council. The very last bar on the right-hand side, massive spike there, which may support the gold price going forward. So gold is formed and will continue to form part of client pensions. And it's important to understand its value as a diversifier in times of woe, and also the dynamics at play in the gold markets today. So that's me done with the kind of later career focus. I've just a couple of slides on that early career client, or indeed the younger contingent in the audience who might be thinking about how to view their pension investments. So first tip is think long term. Your pension is your longest time horizon pot. So why is that useful? Well, this graph shows a study run by Lepper on how risk is impacted by the amount of time you hold an investment for. So just explaining that a wee bit, explaining the graph a wee bit, using data running from 1970 to 2022 and considering worldwide equity returns as the data set. The study took different periods of returns and compared them. So the left-hand bar, for example, shows 1 year rolling periods, i.e. it looks at periods from 1970 to 71, 71 to 72, 72 to 73, and so on. They take the returns achieved over each of those periods and choose the highest and lowest of those returns. And those are plotted on the bar chart in yellow and blue respectively. Moving across to the 3 year period bar, they take 3 year periods from, for example, 1970 to 73, 71 to 74, 72 to 75, etc., and choose the highest and lowest returns and plot them. And then it does it for 5 and 10 years there, obviously, as well. Long story short, the study shows that if you hold investments for 1 year, you can make a very large positive return, in this case, 70% within this data set, that is, or a very bad return, minus 36% here. However, if you hold for a longer period, like 10 years, the best possible outcome reduces to 24% in this data set, but so does your worst outcome to minus 1% here. I think that the important takeaway is actually the ratio. In this data set, holding for a very short time meant that your bad return could be about half that of your best possible return, which isn't a great risk-return trade-off. However, by holding for 10 years in this data set, the risk return was much more favorable, with the best return over 10 years being 24 times that of your worst return. So in your pension, you're literally forced to hold for a long time. It could be said that you can afford to take a little bit more risk in the early years, in the knowledge that you can hold through the volatility, or in fact are forced to hold through the volatility for a long time and benefit from that smoothing of returns that longer periods bring about. And the last tip then, be wary of costs, particularly for long-term holders. This study from the SEC, the Security and Exchange Commission in the US, nicely shows the impact of fund charges on portfolios or pensions values over time. It shows the value of the portfolio which was invested £100,000 over 20 years at a 4% rate of return, taking account of different fund charges over that time. At a 1% per annum charge, i.e. the green line at the bottom, the final value of the investment was $30,000 lower than the final value of the portfolio if we'd only applied a 0.25% per annum charge. Considering we might have 30 or 40 years to play with here, those younger pension holders should really look at the charges they pay both to their pension providers and built into the funds that they hold in their pensions. So practically, how do you tackle that? Know where to look for the charges. Look for the ongoing charge figure, the OCF, on the fund's fact sheet, or if the OCF isn't there, the total expense ratio, the TER, or the annual management charge, the AMC. You might also consider seeking out low-cost passive funds, for example, ETFs, as opposed to a more expensive active managed fund, depending on the performance of those funds. So you have to have a look into how funds are performing if you're going to do that. You'll be glad to know that's me. In summary, bonds and alternatives make up a massive portion of clients' pensions, and accountants might find it useful to have an idea of the drivers of the value of those assets. Think duration and interest rates. And for younger pension holders, think time is on your side and keep costs low where possible. So just before we go into the questions, I wanted to highlight that in this presentation, whenever, if you download it, myself and Alison's information is at the back of the pack, and we'd be very pleased to speak with anybody who wants to have a conversation after this presentation. So on to any questions that have popped up since we started our presentation. So I've one here for Bert, first of all, I presume. Can you stop and start salary sacrifice whenever you want?
The short answer is no. You have to be careful doing this because otherwise you may not be granted national insurance. Well, HMRC will not consider it an employer contribution. You can get out of salary sacrifice if there's a good reason to. For example, you're struggling to meet your bills, etc. So quite often it's something you do for a whole year and then you review it every year. So.
Thank you, Bert. One for Alison. For clients with many inverted commas pots, thank you. For clients with many pots, is it best to consolidate these, and are there any pitfalls?
That's a good question. There are pitfalls. I'm going to say that 80% of my job every day, I am looking at consolidating pensions. So I get approached about this a lot. A lot of clients want that simplified one pension. And I would get clients with lots and lots of different work schemes. And they're coming to me and said, Alison, just put it into one, please. What I do then is I will then get them to complete, sign letter of authority and approach the scheme provider. And what then I can go back and relate to that client is, okay, well, how much do you really want this simplified? As in, you're going to lose some valuable benefits. So guaranteed annuity rates. Last year, there was one chap who got 13% as a guaranteed annuity rate. We found that a blended pension between a flexible access drawdown and taking annuity and not losing that great rate was the solution for him. Or terminal bonuses as well. By cashing it in early, you're losing out on that as well. So I think it's good if I can, where we can, we will try and get a simplified approach. As you say, Aaron, fantastic to look at the charges underneath it, to have the right funds within it, and to really make it work for the client. But there are instances when there are safeguarded benefits, and sometimes you actually do need to leave it where it is. Thanks.
Thanks for that. Thanks for that question. I want to hear from myself. Interesting on duration, but where do we find that information? Yes, I sort of alluded to it during the presentation. Generally, a pension provider will probably have a portal of some description. Very few people actually log on to them, albeit, or if you're, making use of a SIP, you maybe have a greater transparency of what's in there in terms of funds and stuff. But in either case, you can either log into the portal or otherwise find where you're invested. You can literally see the value of your investments and what you're invested in. Find the fact sheet. So the fact sheet being the main thing here. I've seen some providers calling it different things, but 90% of them call it fact sheets, something to that effect. If it's not called that, just click into it. It's probably be a PDF, and it has a lot of information like the ongoing charge figure, If it has bonds in there, it'll have the duration of those bonds. It might have other information like the performance of the fund, among other useful stuff. So I would just say have a look out in portals or otherwise for the fact sheet of the fund that you're invested in, and you'll find a lot of information there. Thank you. Is there, so I presume again this is for Bert, is there a limit as to how much salary you can exchange?
Yes, you can't earn less than minimum wage. So you can't, if somebody was earning 12,000 a year, they wouldn't be able to, or whatever the amount they're earning, they couldn't salary sacrifice the 100% of their salary.
Very good. Another one here for Bert, is salary sacrifice taken into consideration when the calculation of child benefit is made, e.g. salary 51k for the year, but salary sacrifice 3k for the year, therefore there will be no impact on child benefit. Is that correct, or will child benefit be reduced?
No, that's a good question. Whether you pay a pension contribution or you do it via salary sacrifice or you make a personal pension contribution, you will regain your child benefit. So if you're earning between 50 and 60,000, this is another area, you know, a bit like regaining your personal allowance if you're earning over 100,000. And it doesn't matter whether you pay it via salary sacrifice or as a personal contribution, it will reduce your net relevant earnings. And therefore you'll regain, well, with child benefit, you actually have an additional charge. You don't actually lose it. But yeah, that's how it would work. So in answer to that, the £3,000 salary sacrifice won't be taken into account. So.
Okay. I think that's it. I have no other questions here from the floor. I think that's it from us. Zara, I see you jumping on.
I just thought I would jump back on to thank you all. Really insightful and detailed session, and particularly incorporating all those recent changes from the budget just so recently. It was certainly useful. I'm sure everybody that joined online found it equally useful, and I would encourage you all just to fill out your little feedback survey whenever we send those out, because it really does help us to frame what future events we put on for you. So it just remains for me to thank you again, to thank Evelyn for coming on board to support these, and I hope you all have a lovely afternoon.